Welcome to The Explainer. Today, we're taking a look at a data drop that might look like a total cure for insomnia at first glance, but is actually a seriously powerful financial dashboard. We're talking about the Federal Reserve's H.15 release. It's this daily data drop that acts as the absolute pulse of the United States economy. If you want to understand exactly where money is moving and how much it costs, well, this is where you look.
Now, it might just seem like a precise time on the clock, but for financial markets, it's a daily ritual. What exactly happens every single business day at 4:15 p.m.? Okay, let's dive into this.
Here's our roadmap. We're going to hit the daily financial heartbeat, look at the Fed's anchor rates, see how that hits Main Street borrowing costs, decode Treasury yields, factor in inflation, and wrap it all up by reading the whole economic dashboard. Right, Section 1, the daily financial heartbeat. And for this, we're zooming in on a very specific snapshot, the release dated May 26, 2026. The Fed's website just simply states, the release is posted daily Monday through Friday at 4:15 p.m. I mean, it sounds super mundane, right? Almost like an administrative footnote. But this quote literally represents the daily heartbeat of the entire U.S. financial system. At 4:15 p.m., unless it's a holiday, the whole world gets to see the true cost of money across the American economy, updated with the day's actual transactions. Moving on to Section 2, the Fed's anchor rates, the engine of the economy. Think of these anchor rates as the literal engine of the economy. If you want to follow the money trail, this specific number is where the whole shebang begins, 3.62%. As of late May 2026, this is the effective federal funds rate. It stayed absolutely flat at 3.62% across the entire week we're analyzing. But, what does that actually mean for us? Well, the source's footnotes give us this super dense definition, calling it a volume-weighted median of transaction-level data collected from depository institutions. Okay, let's unpack that jargon for a second. Basically, this is the baseline cost for banks to borrow from one another overnight. It's the wholesale price of money. When banks need to hit their reserve requirements, this is the rate they charge each other. And since it's a volume-weighted median, it reflects the actual, real-world borrowing happening in the banking system. It is absolutely the truest anchor for the entire financial market. Let's move to Section 3 and see how this builds. Main Street borrowing costs. How base rates impact you. This is where that massive Fed engine connects directly to your wallet. Look at this fascinating contrast. On one side, we've got the Fed's discount window primary credit at 3.75%. That's the cheap rate banks get straight from the Federal Reserve. Compare that directly against the bank prime loan rate, which is sitting way up at 6.75%. That is a solid 3% premium tacked on before that money ever reaches the broader economy. So, why is this 6.75% prime rate absolutely crucial? The footnote explains that the bank prime loan is the rate posted by a majority of the top 25 insured U.S. banks. It acts as the primary base rate used to price short-term business loans. You guys, this is the actual transmission mechanism. When you hear about credit card rates or home equity lines of credit, or just a local business taking out a loan for a new coffee machine, this 6.75% prime rate is the starting block. It perfectly bridges the gap between high finance and everyday life. Section 4. Decoding Treasury yields, or as we like to call it, the road ahead. If the federal funds rate is our engine, government bonds are basically the headlights of our economic dashboard, letting us look into the future. The H.15 lists this thing called Treasury constant maturities. Now, what's really interesting about this slide is how the Treasury mathematically connects the dots. The footnote clarifies that these yields are interpolated from the daily yield curve. In plain English, they look at the actively traded market and figure out what a bond would yield at an exact fixed term, say exactly 10 years, even if there isn't a specific security maturing on that exact day. It gives us this perfectly smooth curve to measure time and risk. Let's take a look at that yield curve from the May data. Notice these upward steps. The one-year Treasury yields 3.86%. By the time we look 10 years out, investors are demanding 4.56%. And if you want to lock your money away for 30 years, that yield climbs up to 5.07%. This upward slope tells a really clear story. It shows us that investors demand higher compensation, higher yields for locking away their capital for longer periods, taking on the risk of the unknown future. All right, Section 5, factoring in inflation, the weather conditions. If Treasury yields are our headlights, inflation is the weather condition messing with our visibility. And the H.15 release doesn't leave us guessing about this invisible force. It actually gives us a brilliant built-in weather gauge by providing data on TIPS, Treasury inflation-protected securities. Because TIPS are directly tied to inflation, their yields represent the real return investors expect after inflation eats away at their purchasing power. Check this out. For a 10-year maturity, the standard or nominal yield is 4.56%, but the TIPS yield for that exact same 10-year period is only 2.16%. Now look at the 30-year maturity. The nominal is 5.07%, while the TIPS is sitting at 2.77%. So the crucial point here is that mathematical gap. The difference between the standard treasury and the TIPS reveals exactly what the financial market expects inflation to average over that time. It's literally a real-time gauge of inflation expectations baked right into the daily numbers. Which brings us to Section 6, Reading the Economic Dashboard, putting it all together. Let's step back for a second and look at the whole console we've just assembled. What started as just a dry spreadsheet of numbers is actually a vibrant, living roadmap. We saw that the H5 provides the daily heartbeat of finance every day at 4:15 p.m. We found the engine, with anchor rates like the EFFR sitting tightly at 3.62%. We saw that Main Street prime lending rates command roughly a 3% premium over those base rates. We watched the Treasury constant maturities form a clear upward-sloping curve. And finally, TIPS highlighted the baked-in inflation expectations for us. Every single time a bank issues a loan, or a company plans an expansion, or you even swipe your credit card, these numbers are quietly running the show in the background. The Fed's daily dashboard isn't just some abstract thing for Wall Street. It directly impacts your wallet. So I'll leave you with this to consider. How will these fractional percentages dictate your next big financial decision? Thanks for joining this explainer. Keep an eye on those numbers.